before we talk about the current environment for the markets, let's go back to mid-February when you said you were kind of grumpy with the valuations at all-time highs for the major indices, and you were at 22% cash. Why were you grumpy, and what were some of the factors that went into that thinking and strategy?
That's a good question. Actually, we got grumpy earlier than February. I've been grumpy for about 6 months because valuations have been sort of moving up higher and higher. Profitability in 2019 was really growing at a pretty modest pace. Investors kept paying higher and higher multiples for really pretty stagnant profits for the general stock market. Some companies are obviously exceptions. And so it was irritating because, one, we were happy because we were invested in the markets, but as things got more lofty and investors got more frothy and going into the year end of 2019 in December, we started taking some money off the table because the higher things go, the riskier they become in many respects. And our attitude is we'd rather be buying things at cheap prices, and the higher things go, as the risks are kind of materializing, we were getting quite apprehensive.
Now, we've seen crashes in the stock market since they began. You've been in the business for more than 35 years, so you've been through a lot. 87 and then and on since then, financial crisis and so on. So how is this one different, and how is it the same? Because I'm assuming there are a lot of similarities, because a lot of these crashes are just based on herd mentality and human emotion.
They're all the same in the sense that they're generally, there's some degree of panic involved. There's usually bear markets or corrections of more than 20%. We've qualified for that now. The stock market crash of 87, there were investigations into why it crashed for years and years, and there was no real simple answer. The tech wreck in 2000, that was a bubble and a lot of lofty dreams and business models that didn't make sense. 2008, 2009, that was a financial crisis. This one started out as, we started paying attention to it in early January and became increasingly concerned. What started out as a health crisis has now really evolved into a financial crisis, because as you shut down major cities, that starts having major economic impacts. So in that respect, it's similar. The causes of it are always a little bit different, but the behaviors are always the same, and the concerns that investors express through lower prices are always the same. And you always get those emotional, raw periods where you're getting close to the bottom, and then you have to sort of check yourself and say, you know what? Just when you think it's going to get better, there's always something that's going to get worse. And I think you have to get to a point where the people that are uncomfortable being investors in the stock market, or the people that need to sell because this leverage has been being unwound, they all have to leave the room. And you have to start having investors who begin to focus on why they are actually investing in the stock market. And we haven't gotten rid of enough people yet who just buy the stock market because they think it's a place to make money, rather than a place to invest money as a store of value for the long term, and investing in good quality companies that will work for you over the long haul.
You've said, and you've written recently, that investors need to be reflective. They have to put this in some context. They have to have some perspective on this. So what do you mean by that? And how do you get to that calm place where you can view the market that way and view your portfolio that way, even though maybe you've been hammered?
I think you have to separate the price of the security that you see on any one given day to the value of what that business is likely to be worth in 2, 3, 4, 5, 10 years. And too many people make the mistake of looking at the price the stock market gives them as a signal of value. That's just a signal of value that people are expressing, a limited number of people are expressing on that given day. And oftentimes those people have very, very short attention spans and don't even care, much less know what those companies are actually doing. So to put things in perspective and say, okay, is McDonald's still selling hamburgers? And in a worst case scenario, for example, if they close down the McDonald's store, how long is it going to stay closed for? It's obviously a hit to McDonald's profitability in the short term, but what's it going to look like in 2 or 3 years' time? So I think people have to start thinking and looking at these prices and the values that are existing and say at one point, okay, at what point are people going to start buying hamburgers again? And McDonald's is the leading fast food chain in the world, and it's going to be just fine. It's trading at this valuation, it's paying me this much of a dividend, and within 6 months, they'll be selling the same number of hamburgers and probably more as the population grows over time.
There are those who might say, look at a Carnival and think it's been so beaten up. I'm going to get into that. It'll bounce back eventually when things are normalized. But you say no, you want to high grade your portfolio. Define that for us. What does that mean?
Loblaws sells groceries. It's a pretty good business. And Walmart sells groceries. All right. Walmart and Loblaws are both down 20%. But really, Loblaws is a better business. Or Walmart's a better business. Okay. It's an opportunity for you to go, okay, I'm going to sell my Loblaws and I'm going to buy a much, much bigger, more broadly diversified stock in the States that also has operations in Mexico and Canada. It has all kinds of other opportunities, whereas Loblaws is restricted to like a local Canadian market. So it's an opportunity to look at and say, everything's down. There may be some tax advantages to high grading your portfolio by selling losers and buying great companies that are international in nature, where you can get international diversification. Apples and oranges, they're both down by 20%, but the oranges are better for you in the longer term.
Two other names you've mentioned in conversation, and not to turn this into a whole top picks thing, but are, speaking of high grading, Visa, Microsoft. These are companies that were trading at all-time highs, maybe too rich for some people's blood. I don't want to chase it, they're thinking, but now they look a hell of a lot more attractive, don't they?
Yeah, it's a great example of high grading your portfolio. Visa's an amazing company. The online transactions are growing around the world. You could argue today that, contactless transactions are going to grow even more quickly because some people think that germs are on currencies and you don't want to touch currencies any longer. Be that as it may, Visa has always been a stock that trades at like 35 times earnings. Well, it's down 30% here. People are worried about people aren't going to go shopping for the next little while. So now it's trading at about 25 times earnings. Maybe you might get it for 20 times earnings, and you probably will. When the market hits bottom, those great companies are trading at prices you haven't seen in 4 or 5 years. And that's when you go, now I know we're there.
Speaking of the bottom, something else you've been writing to clients lately, in a rather comedic note a while ago, was, as part of it, we think the S&P 500 around 2,100 makes sense in terms of a bottom. So are we there yet? And if not, when do we get there? Are we looking out several months? Or I know it's hard to gauge that.
Yeah, and we get asked the question because we've been telling our clients that we have cash and that we're really enthusiastically embracing this crisis. Obviously the health impacts aside. Bear markets typically have averaged around 35 to 40%. So we're not quite there yet. I think we could see another 15 to 20% drop. That wouldn't really shock me. And once again, that's the Visas of the world finally going down that final little bit. It's the big ones that everybody holds on to, and it's when they're exhausted and people sell the things, not that they want to, but the ones that they can sell. That's what takes them down to that level. Last year, the S&P 500 earned $152 a share. People thought it was going to grow 8%. Now they're saying 5%. So just say all the estimates are in the garbage. $152 a share in earnings. Put a 14 times multiple on it, which is not overly aggressive in a pessimistic perspective. That gets you to 2,100. And we're trading somewhere around 2,500. So people think, oh, it's fallen a lot. I remember back in 2000, people thought AOL had fallen a lot. Cisco had fallen a lot. Cisco's not back to the prices that it was at in 2000. These stocks were very highly valued before. And you have to be brave enough to say, I'm not going to participate just because everybody else is, following along in this charade of things are wonderful. There's always something that happens.
And lastly, John, if somebody wants to get a hold of Davis Ray and or sign up for the newsletter, how do they do that?
Davis Ray, DAVISREA.com. There's a blog there. You can sign up for it, and we send out newsletters. But for sure, feel free to give me a shout, and I'm always happy to talk to our clients. That's who we take care of, as individual investors, and that's what we like to do.